Most people believe markets move because of news. A headline appears. Prices react. Bad news pushes markets down. Good news sends them higher. That explanation feels comfortable because it suggests markets are responding to the same information everyone else can see at the same time. But that view is incomplete. Markets don't fear bad news. They fear what most people haven't noticed yet. By the time a headline reaches your screen, it has already been read, debated, and priced by participants who operate far ahead of public attention. Prices rarely move because information exists. They move because structure changes, quietly, gradually, and often without drama. Liquidity shifts, relative purchasing power changes, long-term incentives realign. And when those underlying mechanics adjust, prices eventually follow, even if nothing looks alarming on the surface. This is why markets can look calm right before volatility increases. Nothing appears broken. Indices may even sit near highs. But beneath that calm, the forces that determine long-term outcomes may already be moving. Retirement planning is especially vulnerable to this misunderstanding. Many people anchor their expectations to recent performance or widely accepted strategies without asking whether the underlying conditions that supported those outcomes still exist today. So the real question isn't whether prices went up or down last week. The question is whether the foundations that support long-term value are quietly shifting and whether most people are paying attention. Over the past several weeks, financial markets have experienced a period of elevated volatility across multiple asset classes, including equities, precious metals, bonds, and currencies. Gold and silver prices moved sharply higher earlier in the period, reaching levels not seen in recent years, before experiencing a rapid pullback over a short time frame. The decline occurred quickly, with a large portion of the move concentrated within a small number of trading sessions. Despite this pullback, prices for both metals remain significantly higher than they were several months earlier and continue to trade above many long-term technical reference levels. Equity markets, including broad U.S. indices, have remained near historical highs. However, price action has become more uneven, with increased day-to-day swings and sector rotation becoming more pronounced. Dividend yields on major equity indices have continued to trend lower as prices rise faster than cash distributions. In fixed income markets, government bond yields have fluctuated as investors reassess expectations around inflation, economic growth, and monetary policy. Movements in Treasury yields have been closely watched, as changes in yield levels directly affect currency strength, equity valuations, and the opportunity cost of holding non-yielding assets such as gold. Currency markets have reflected this uncertainty. The U.S. dollar has shown periods of strength and consolidation rather than a clear directional trend, indicating ongoing adjustments in global capital flows rather than a decisive shift. From a longer-term perspective, these recent moves did not occur in isolation. They followed several years of rising consumer prices, increased government borrowing, and persistent adjustments by central banks in response to inflation pressures. None of these conditions began this month, and none have been resolved within it. Compared with last month, the primary change has been speed, not direction. Price adjustments that previously unfolded gradually occurred more rapidly. Liquidity conditions tightened briefly, and short-term positioning was reduced across multiple markets. Importantly, no formal changes to monetary policy frameworks, retirement systems, or fiscal structures were announced during this period. The volatility reflected market recalibration rather than a response to a single policy event. These are the observable facts: faster price movement, broader volatility, and continued uncertainty, without a definitive structural resolution. To understand why these recent moves matter, it's important to separate headlines from mechanics. Price volatility itself is not the story. Volatility is a symptom. What matters are the underlying forces that create it, and how those forces interact over time. At the most basic level, markets are balancing three competing pressures: inflation, persistence, interest rate expectations, and capital allocation choices. When inflation remains above long-term targets, even if it is no longer accelerating, it changes behavior. Savers become more sensitive to purchasing power erosion. Investors reassess the real, inflation-adjusted return of traditional assets. This does not happen all at once. It unfolds gradually, often unevenly, and across different markets at different speeds. At the same time, higher interest rates alter incentives. They increase the cost of leverage, raise the hurdle rate for investment, and shift capital toward assets perceived as offering stability or protection. This affects equities, bonds, currencies, and commodities differently, not because one asset is good or bad, but because each responds to rates in a distinct way. For non-yielding assets like gold and silver, the key driver is not short-term price movement, but opportunity cost. When real yields rise, holding metals becomes less attractive in the short run. When real yields stabilize or fall, that pressure eases. Recent price swings reflect short-term adjustments to these changing expectations rather than a reversal of longer-term trends. There are also second-order effects that are easy to overlook. As equity prices rise faster than dividends, income-focused investors face a growing gap between asset values and cash flow. This matters most for retirees or those approaching retirement, where income stability often matters more than nominal price appreciation. Additionally, increased government borrowing and long-term fiscal obligations influence how institutions think about reserves and risk management. Central banks, pension funds, and large asset managers operate on multi-year horizons. Their allocation decisions tend to respond to structural considerations rather than daily price moves. The impact of these forces is not felt evenly. Short-term traders respond first to changes in liquidity and positioning. Long-term investors respond later as trends persist and relative value becomes clearer. This staggered response is why markets can experience sharp moves without an immediate change in long-term fundamentals. What matters most is not where prices ended the week, but what incentives are being reinforced. When incentives shift, even subtly, capital eventually follows. Understanding that chain reaction helps explain why recent volatility deserves attention, even if it does not yet represent a definitive turning point. When markets enter periods of heightened volatility, it is natural for investors to search for historical parallels. History, however, is most useful when it is used to reduce emotional bias, not to predict outcomes. There have been several periods over the past few decades when conditions look broadly similar to today, not in exact price levels, but in structural alignment. One such period followed the early 2000s equity market peak. At that time, equity valuations were elevated, real returns were compressed, and investors were forced to reconsider assumptions about long-term growth. What mattered most during that transition was not the initial decline in asset prices, but the slow realization that the prior decade's conditions were no longer in place. Another comparable environment emerged in the years following the global financial crisis. Interest rates were historically low, monetary policy was highly accommodative, and asset prices rose steadily. However, inflation pressures were subdued, and purchasing power concerns remained largely theoretical rather than lived experiences for most households. What is similar today is the reassessment phase. Investors are once again evaluating whether the frameworks that worked in prior cycles remain valid. Questions about real returns, income generation, and long-term purchasing power are moving from abstract discussions into practical planning considerations, especially for those nearing retirement. What is different this time is the starting point. Inflation has already been experienced, not merely feared. Government debt levels are materially higher across most developed economies. Demographic pressures on pension systems and social programs are more visible. These conditions change how long-term risks are perceived and managed. It is also important to note what history does not tell us. Past performance does not define timing, magnitude, or sequence. Markets rarely repeat outcomes in the same order or at the same pace. Sharp rallies and pullbacks occurred in previous cycles without determining the final long-term trajectory. The key takeaway from historical context is not that a specific outcome is inevitable, but that transitional periods tend to last longer than expected. During those periods, assets that preserve purchasing power over long horizons often regain attention, not because of fear, but because of arithmetic. History, when used properly, reminds us that volatility is not unusual during structural shifts. It also reminds us that emotional reactions to short-term moves often obscure the slower, more consequential changes happening beneath the surface. At this stage, responsible analysis requires probabilistic thinking, not conviction. Markets are not at a point where a single outcome dominates. Instead, several paths remain viable, depending on how key variables evolve. Rather than predicting what will happen, it is more useful to outline what would need to happen under different conditions. Bull case, gradual strength continues. In this scenario, inflation continues to moderate without returning to the ultra-low levels of the previous decade. Interest rates stabilize rather than rise meaningfully from here, and real yields stop exerting increasing pressure on capital allocation decisions. If this occurs, assets that benefit from purchasing power preservation may continue to attract long-term capital. Equity markets could remain supported, but returns would likely come more from earnings and cash flow than from valuation expansion. For precious metals, stability in real rates would reduce opportunity cost pressure, allowing prices to respond more to structural demand and long-term allocation shifts rather than short-term positioning. This outcome does not require aggressive monetary easing or economic acceleration. It simply requires no major deterioration in inflation control or financial stability. Under these conditions, volatility would likely compress over time, and trend continuation would be driven by fundamentals rather than speculation. Base case extended adjustment phase. The base case assumes neither a clear acceleration nor a decisive breakdown. Inflation remains uneven, interest rates fluctuate within a range, and economic data sends mixed signals. Markets continue to rotate rather than trend strongly. Short-term price swings persist, but longer-term levels remain broadly intact. In this environment, returns across asset classes are likely to be more modest and uneven. Income generation, balance sheet quality, and liquidity become more important than headline performance. Investors increasingly differentiate between nominal gains and real purchasing power. For metals and other real assets, this scenario implies continued sensitivity to interest rate expectations without a clear directional catalyst. Price advances may be interrupted by sharp pullbacks, and patience becomes a defining advantage. Historically, these adjustment phases tend to frustrate both optimists and pessimists, as markets move just enough to maintain uncertainty without resolving it. Bear case, structural pressure reasserts itself. The bear case emerges if inflation reaccelerates or financial conditions tighten more aggressively than expected. If real yields rise materially, or if economic stress forces rapid repricing across credit and equity markets, liquidity could contract. In such an environment, most assets experience downside pressure initially, as capital prioritizes cash and short-duration safety. Under these conditions, correlations often rise temporarily. Assets that are typically defensive may still decline in nominal terms before stabilizing. What differentiates outcomes is not the absence of volatility, but the speed and scale of recovery once forced selling subsides. This scenario would represent a decisive shift, not because prices moved lower, but because underlying incentives changed sharply. It would likely require a policy error, a resurgence in inflation, or a sudden deterioration in financial stability. Across all three scenarios, one principle holds: markets respond to conditions, not narratives. The purpose of outlining these paths is not to choose one, but to remain prepared for each. Risk management is not about certainty. It is about alignment, ensuring that positioning does not rely on a single fragile assumption. Rather than reacting to headlines or short-term price movements, I focus on a small set of indicators that tend to signal structural change rather than noise. These indicators help distinguish between temporary volatility and meaningful shifts in market conditions. One of the most important is the US dollar index, DXY. Sustained strength or weakness in the dollar influences global liquidity, commodity pricing, and capital flows. Short-term fluctuations matter less than trend persistence and the relationship between the dollar and real yields. Closely related are U.S. Treasury yields, particularly real yields after accounting for inflation expectations. Changes in real yields directly affect the opportunity cost of holding non-yielding assets and influence equity valuation frameworks. I pay particular attention to whether yield moves are driven by inflation expectations or by changes in growth assumptions, as the implications differ. Inflation data, including CPI and PCE, remains critical, not for single monthly prints, but for trend confirmation. Consistency across multiple releases matters more than one outlier. I also watch how markets react to the data, not just the data itself. Market response often reveals positioning and expectations more clearly than the numbers. Liquidity conditions provide another layer of insight. Measures such as market volume, funding stress indicators, and participation across asset classes help assess whether moves are being driven by conviction or by forced repositioning. Thin liquidity can amplify price swings without reflecting long-term intent. Finally, I monitor positioning and open interest in futures and options markets. Extremes in positioning often precede reversals, not because fundamentals changed, but because the trade became crowded. When positioning normalizes, markets tend to behave more rationally. None of these indicators offer certainty in isolation. Their value comes from convergence. When several move in the same direction, confidence in the underlying signal increases. By focusing on these inputs, the goal is not to predict exact price levels, but to understand whether the environment is becoming more supportive, more restrictive, or simply more uncertain. That understanding informs patience, position sizing, and risk control, which matter far more than being early or late. As we close, it's important to keep perspective. Periods like this can feel confusing because prices move faster than narratives adjust. But uncertainty is not the same as danger, and volatility is not the same as failure. Markets routinely pass through adjustment phases as incentives realign and expectations reset. The discipline comes from focusing on what can be observed, measured, and monitored, rather than reacting to what feels urgent. Long-term outcomes are shaped less by short-term precision and more by consistency, risk management, and patience. No single asset, strategy, or time frame holds all the answers. Diversification, liquidity awareness, and an understanding of real purchasing power remain central to sound financial planning, particularly for those thinking beyond the next market cycle. This isn't investment advice. It's simply how I'm reading the market right now. The goal is not to predict the future, but to remain adaptable as it unfolds, grounded in evidence, aware of risk, and focused on the long term.